A pleasant good afternoon to our beloved clients, and welcome to the RCBC Economic Briefing. I am Stephen Reyes, Treasury Sales Head, and I will be your host for the day. Allow me to begin by thanking everyone for attending this briefing under unusual circumstances, and we hope that we can, in our own little way, be able to help each and every one of you to come out of this session with more information and a clear appreciation of our current situation. Before we enter the briefing proper, let us first lay down the rules for this webinar. All participant devices will be put on mute by the host to ensure that there will be no audio feedback that may disturb the proceedings. There will be a Q&A session, and should you have any questions, please feel free to use the Q&A button anytime during the presentation, and we will endeavor to respond to them during or after the briefing. Thank you for your understanding. We are now on our 53rd day of ECQ. Hopefully soon we will get a clear picture of whether we will indeed exit ECQ on May 15th. What started out as a temporary work setup has now been transformed into a new norm. Work from home was prior to ECQ a luxury afforded to a few. And little did we know that the ECQ would force us all to consider work from home as a viable option. After almost 2 months, the ECQ that we know for sure is that our economy has been brought to its knees. The US GDP printed negative 4.8, China negative 6.8, Europe negative 3.8, and for the Philippines, for the first time since 1998, a quarterly GDP of negative 0.2. Note, we should expect that the second quarter will be worse, except maybe for China, which has already lifted their ECQ. This episode, this crisis, is like no other that we have been through. Most of the crises we have experienced have been generally isolated. We had the Asian financial crisis centering in Asia. We had the CDO crisis centering in the US property and banking system. We had the European sovereign crisis centering on the European nations, Portugal, Italy, Greece, and Spain. But unlike those mentioned crises, this one that we have right now is far more expansive and swift, as if a switch has been turned off. Critical to us now is to be able to read the lay of the market post-ECQ. Today, we will attempt to provide you with tools that will guide you in understanding our market environment and that will hopefully allow you to make informed decisions. Today, we will try to answer questions like, where do we go from here? What will my funding situation be? How will my cost of operations be affected? How long before a full recovery returns? Or even as personal as, when will my next trip to Japan be? With this backdrop, allow me to introduce the head of SME Banking Group. She is familiar to all of you as she has been the key mover in delivering to our SME banking clients the personalized service that you are now so accustomed to. Our SME Banking Group Head, Angie Tino, to give her welcome remarks.
Good afternoon, everyone. In behalf of our President, Mr. Eugene Acevedo, who unfortunately cannot be with us today due to an emergency meeting with other bank CEOs, we would like to welcome you to this virtual forum where RCBC's Chief Economist will give us insights as to how our economy will fare under this COVID environment. Although the scenario may look grim at the moment, there are certainly still some bright spots out there that the business community can take advantage of. Certainly for RCBC, we're using this ECQ as an opportunity to strengthen our digital footprint And this one we will also discuss briefly after this forum. Before we proceed though with this webinar, what we would like to do here is to take advantage of this opportunity also to assure our customers, especially our borrowing clients, that RCBC is not the type of bank who will take the umbrella away when it's raining. We had learned our lessons from the Asian crisis. So definitely we will be here to support you in whatever way we can to tide you over. Whether you're engaged in the vulnerable sectors where you probably will need a bit more time to recover, or whether you are in the essential industries where in fact you may need additional working capital requirements to fund your operations. We will just have to work together, support each other, journey together. We're practically going through uncharted waters on this one. This is not like just the Asian crisis, because this is a health crisis as well. So hopefully at the end, we will come up with a win-win solution that ultimately we hope will strengthen our relationship. So thank you again for accepting our invitation, and I turn you over back to Stephen for the webinar proper. Stephen?
Thank you very much, Angie. Thank you for that very ensuring remark. To deliver the RCBC briefing entitled "The Economy in the Time of COVID" is a very familiar face to most of us. He is the chief economist of RCBC, a regular resource of various media outlets like ANC, CNN, and Bloomberg. He is a many-time awarded Best Economist by award-giving bodies like The Asset, and recognized as one of the most accurate macro forecaster by the Department of Finance. Here to give us his macro, policy, and market views, Mr. Mike Ricafort.
Okay, pleasant afternoon to everyone. Thank you so much, Stephen, for the generous introduction. Well, I do hope that you're doing well because right now the environment is kind of challenging, may have been difficult for some of us, especially the most vulnerable sectors. And hopefully this afternoon will make it as productive as possible. Now, I'd like to start the presentation. First, this is how we see things in the future. So, as mentioned by Stephen a while ago, economic growth, or GDP, has already come out this morning. It was negative 0.2%. So that's the first decline in 21 years. Because Philippine economic growth has been consistently positive since 1999. So we're coming from a position of strength. Even our economic growth has been growing by at least 6% from 2012 to 2019. So now, this is primarily, as pointed out by Ms. Tino a while ago, a health crisis. It's neither economic, it's not also financial in nature, unlike the previous economic cycles. We're coming from a position of strength, our economy, where the Philippines is among the fastest growing economies in Asia and among relatively larger countries around the world. Same goes with the rest of the global economy. We have seen improvements in recent years. It just happened now that this is a deliberate effort, not just locally, but many other economies, even the most powerful and the most developed economies around the world, to do lockdowns, and able to prevent the COVID-19 from spreading further. Clearly, the policy priority right now of the world is to save lives more than anything else, even if it means sacrificing economic growth, output, production, sales for 2 months or so. So that's already clear by now. But of course, expect economies to contract. Just like, look at that forecast. We're estimating now GDP decline for the full year 2020 at between -2% to -4% after the data that came out. So, well, the reality is, even around the world, in view of the lockdowns, this is already the biggest decline or biggest contraction in the economy since the Great Depression. But we have to take note, this is all made by choice and by design by governments around the world. Because so far, the economies can still afford it, just for the sake of saving thousands, if not millions of lives, which is the penultimate objective right now. So how do we see things from here? So it's a matter of, okay, there may be a risk of recession because of the deliberate effort to close down, to lock down, so that the COVID-19 won't spread. So the risk of recession could happen locally and worldwide as well. That's why governments around the world are doing records amount of stimulus measures. They're doing lots of spending, especially to provide financial aid to the most vulnerable sectors, such as those who lose jobs locally, as well as the OFWs, micro, small, and medium enterprises. As we have noted lately, that the policy priority of the central bank has been to support and encourage greater lending to SMEs and to bring down as much as possible borrowing costs. We have this luxury right now of low interest rates. If you compare it in the previous periods, in the previous cycles rather, we have record low interest rates now, 2.75 for the BSP. And that could still be reduced further because inflation is a little over 2%. So inflation would set the floor for interest rates fundamentally. But our interest rates here in the Philippines are still relatively higher compared to other Asian countries. Some Asian countries are already close to zero, if not negative, the likes of Japan. So we still see the exchange rate to be relatively stable. It closed today at 50.46. That's still among the strongest in 2 years because of record GIR, as well as relatively lower. We've seen the sharp decline in global oil prices lately. So that's going to help reduce our oil bill. Because for every $10 change in oil, the Philippines saves around $1 billion per year. So oil prices have gone down already by $40 to $50. So that already means a savings for the Philippines of $4 to $5 billion. And that part explains why the peso is strong. And also, our interest rates remain relatively higher, and that's going to provide some value or higher interest rate returns for foreign funds, especially now that the Philippines is rated 2 notches above investment grade. We're 1 notch away from A credit rating. So that's also supporting our currency as well. Now, how do we see U.S. interest rates? It would remain zero. The consensus now, it would last there for the next 2 to 3 years. Okay, next slide, please. So look at our economy. It has been very strong, above 6% levels since 2012 to 2019. So that is where we're coming from, this position of strength right now. Okay, next slide, please. Now, what's the consensus? How does the world see the Philippine economy? The estimate is around close to zero, or if not slight negative. Well, for next year, well, it would be stronger, around 6 to 7% at least. But we're coming from a low base, because if you average the two, say, let's put it at least 6% from slight negative this year. If you average the two, that's still around 3% or below. That's still below average if you eliminate the base effects. So meaning the recovery could take a while, maybe 1 to 2 years, as many industries have already signaled. It would take the auto manufacturing about a year, other discretionary or non-essential goods, those that produce that would take about maybe 1.5 to 2 years. Okay, next slide. So this is how we see things. Well, we have been used to seeing economic growth of 6.5%. Had it not been for COVID-19, that's our growth, 6.5. That would be erased this year. Even the IMF is already seeing close to zero growth this year. And I'm sure a lot of them will revise it after the latest data that came out. And next year, it's 7.6%. That's close to the BSP's estimate of 7.8%. Next slide, please. So our rule of thumb, for every 1% equivalent to the Philippine economy, that's around 200 billion worth. Now, the estimated losses could be at least 1 trillion realistically. 1 trillion because it would, what would you need to erase the growth, the typical growth this year? Maybe between 1 to 1.2 billion. So that's the minimum economic losses that's being estimated right now. Okay, next slide, please. So now here are also the rule of thumbs, the lockdowns, the ECQs. So for every month of lockdown, that's equivalent to 8% of the yearly production, sales, and income foregone or lost by the most vulnerable businesses, industries, and sectors. Those were shut down completely. That applies, 8% of the yearly output, sales, and income. Now we already have 2 months. So that's equivalent to 16%. For the first quarter, we only have 2 weeks. The one that came out, the data that came out this morning, that's equivalent to 4%. Okay, so that's enough already to erase the full year economic growth. So until, it depends on how long the lockdowns would last, because there are now expectations that the ECQ could be eased after May 15. There are many economies around the world now that are preparing the reopening of their respective economies. Okay, next slide, please. But before that, I'd like to point out that, okay, the Philippine economic growth may be slight negative 2% to negative 4%. How does that compare? In other Asian countries, it's much worse. It's negative 5% to negative 10% in other ASEAN and Asian countries. In other developed countries, especially in Europe, it's between negative 10 to negative 15%. So the Philippines would still do relatively better. Now, here are the most vulnerable industries. Especially, well, now, even before the lockdown, the tourism sector, such as airlines, transport, and other tourism-related industries were adversely affected already. Now, also, other allied industries, even crowded businesses, because social distancing would be a norm. Not only now, this is already the foretaste of things to come. In the coming months, that could still be sustained, especially if the ECQ would be eased to GCQ. So social distancing would continue in the coming months, and that's going to slow down the economic rebound, or that would make it gradual or slow. So consensus is 1 to 2 years for a lot of industries, especially the big ticket ones. Even manufacturers of non-essential products, export industries, because their export markets were in lockdown. Well, we have seen export figures down by 25%, imports down by 26%. That's a consequence of that. Manufacturing is down by 6% as of March. Tourism receipts are 30%, and so on. No? Even some vehicle sales already down by double-digit figures. So that's already a foretaste. We're not really that surprised to see a slight negative economic growth, and that could still continue on. We may also have to consider OFWs that lost their jobs and local employees or workers who were also who were displaced, both in the formal and informal sectors. Next slide, please. And even businesses are considered cyclical, meaning if there's economic downturn. So that includes discretionary products, luxuries, big ticket items, highly leveraged or highly indebted industries. But there are exceptions to this, especially if they're principals or if they belong to large conglomerates with deep pockets. Well, there would be also increased digitalization of businesses, meaning now there would be less need for person-to-person contact for safety reasons. Even when workers start to go back to work slowly or gradually, businesses would protect them more with measures, with PPEs, disinfectants, even their customers. So that would be a new norm. Well, now, so that's your cue. Even workplaces, there would be more spacing requirements. That's going to, even in the transport sector, that's going to increase the cost per area. Next slide, please. Even the property sector is expected to also correct lower. Maybe correction that's at least 10%, that's already signaled by the biggest property brokers. Correction in terms of price on the rentals, correction of at least 5% on rental rates. So here are the biggest sources of tourists. So it will take a while. Even Thailand. Thailand has been known for its huge tourism industry. What would sustain the recovery would be the availability of a cure or a vaccine. They admitted that. Okay. Next slide. So basic necessities, the essentials would continue because people would tend to be more conservative. Businesses, even consumers, households, other institutions, because of the reduction in business transactions due to the lockdowns, they would be more conservative for the meantime. So it would take a while. Give it some time before they recover. So they would stick to essentials. And there would be also further increase in digitalization of businesses, online businesses, as well as processes, even dealings with the government, as well as on the educational sector. Next slide, please. So this has been what we have been mentioning a while ago. The new normal, as we mentioned, the social distancing. There would be greater cost on space. There would be more shifts. There would be work from home. The increased digitalization practically of everything that's possible. Also, increased policy reforms on food security, disaster preparedness, pandemic, healthcare system, and other fiscal reform measures. And the fastest stimulus measure would be increased infrastructure spending, especially now if we move to GCQ. Next slide, please. So this is, anyhow, I'll be providing you with the slides. These are just the basic distinctions between ECQ and GCQ. If we are to move towards GCQ, hopefully as early as the second half of May. Next slide, please. So here are the areas under GCQ. We have a little over a week to go, 8 days to go. Okay, next slide, please. So here are the industries that have been allowed so far in both GCQ and ECQ. Next slide, please. So, okay, next slide. Maybe we move to GCQ. So the only differentiating factor here is that the economy would start to reopen gradually, especially we would see heavy industries resuming, construction, real estate, most especially, and other heavy industries, even real estate. Next slide. Okay, next slide, please. So, well, this is this is how we see things in the future. Just expect records amount of stimulus to counteract the economic slowdown. Also measures, increased deficit spending by the government, just to make sure they give social amelioration, assistance to MSMEs, such as credit guarantees, as well as greater incentives or incentivizing the lending to MSMEs. Well, why is that important? Because it would help provide a lifeline when it's needed most. And at the same time, to preserve jobs, enable to prevent businesses from closing as much as possible. And for those with deeper pockets, it's cheap to borrow now, among the lowest levels in 3.5 years to borrow. If there's an opportunity, that's now. And that's by design. That is what central banks around the world would want. Enable to spur greater economic growth, stimulate more economic activity, create more investments, create more jobs, and hopefully there would be more growth. Okay, so next slide. So we will see the market, a lot of gains in the financial markets also, because there's so much liquidity infused by the central bank. So that's gonna lead to more gains in the bond market. As we've been seeing now, a lot of money has been made there, and that's also favorable for borrowers. As mentioned a while ago, some pickup already in the local stock market, and the peso has been relatively strong. And oil prices have been helping that as well in lowering inflation, since the country imports almost all of its oil. Next slide, please. So maybe let's go now to the recap. Okay, so what's the best thing to do now? The most favorable thing to do is where money has been made a lot, meaning in the interest rate markets. Long-term interest rates, even short-term interest rates have gone down dramatically. Long-term interest rates have gone down by almost 200 basis points just in just a little over a month since the latter part of March. So from the point of view of investors, they made so much money. They made at least 15% in just a month. So if you annualize that, that's 180%. And at the same time, from the point of view of borrowers, this is one of the best times to lock in long-term borrowings. All kinds of borrowers, especially those with deeper pockets, the conglomerates, the biggest businesses, even small businesses, the MSMEs. That's a good thing now. We have low interest rates. That's gonna really save a lot of businesses, save a lot of jobs. And that's the least that could happen. There would be more lifeline on top of the credit guarantees and the other assistance, other measures by the central bank to provide greater incentives on lending to the MSMEs. And also the consumers would also be attracted also to borrow, able to finance the purchase of property and vehicles. Now, the peso has been relatively stable, well supported at 50 levels. Even the stock market, the valuations are relatively lower at 12 times price to earnings ratio. That's among the lowest in 9 years. The fair valuation actually after the lockdowns or the ECQ would be a decline of at least 10% from the end 2019 levels, meaning that would be around 6,500 to 7,000 levels. Currently, it's a little over 5,500. So more likely, we've seen already a good bottom, major support between 4,000 to 4,500. As long as 4,500 holds, no problem. And so expect the economic contractions, but this will be met by strong measures by governments, learning from the lessons of the past crisis periods, past recession, the global crisis. So they would come up with unlimited amounts of infusions of liquidity by the central banks, enabled to further bring down borrowing costs, as well as the record stimulus measures by the government, just to make sure that to offset the economic fallout brought about by the contraction. So with that, thank you very much, and stay safe, everyone.
Thank you very much, Mike, for taking us around the global financial markets in 20 minutes. As we now enter the Q&A proper, allow us some time first to organize the questions that you have sent. And while we do that, let me introduce a partner of ours from the Global Transaction Banking Group, Nathan Chinquanco, who will be providing us with a short presentation on the products of global transaction banking.
Okay. Thank you, Stephen, for that introduction. Good afternoon to all. I'm Nathan Chinquanco from Global Transaction Banking. I look after the Business Development Division, offering corporate cash management solutions to our business partners like you. For this afternoon, allow me to share to you 6 relevant online payment solutions of RCBC, housed within our online banking channel called RCBC Online Corporate, or simply called ROC. Now, what do I mean by saying relevant payment solutions? Well, since we are all within our ECQ situation, we have been directed to follow social distancing so that we can flatten the curve, slow down the potential transmission of COVID. And since most of our business activities will have to continue, like paying your obligations to your vendors, this will definitely require physical and outdoor logistics. It now begs the question, how do we do it? Through checks? Pwede, definitely. There's really nothing wrong in paying by checks. But consider nowadays, preparation of checks require printing, getting it physically signed, and finally giving it to your vendor. And all in all, this is a big logistic challenge to hurdle at this time. We believe by going online, we can achieve the same results within the confines and safety of our homes or business place. That said, I'd like to share to you our 6 online payment solutions for your consideration. Let me explain briefly what each solution is all about. Well, looking at the slide, on the left side of the slide is RCBC's funds transfer solutions sent to other banks. And on the right side are transfers to accounts within RCBC. In effect, the ones of transfers within RCBC are considered as book-to-book transfers. Okay, so I'll tackle first the payment solutions to the left side. First on the list is PesoNet. PesoNet is our peso funds transfer facility that provides same-day value credit to your vendors. The amount of transfer that you can make using PesoNet has no limit. For as long as your approval limits are defined in your board resolution, ROC will allow you to pay. For instance, if you got billed by your vendor for 3 million pesos, and your board resolution says that you can make or pay 3 million pesos, then ROC can recognize that limit and allow the transfer to happen. Second is InstaPay. As the name says, it's an instant payment providing real-time credit. It's real-time payment for a maximum amount of 50,000 per transfer. Through ROC, your company can make multiple InstaPay transfers if you need to pay your vendors for an amount more than 50,000 pesos. For example, let's say your vendor bills you for 150,000 pesos. Now, to use InstaPay, you will have to make 3 separate 50,000 peso transfers, all totaling 150,000. And yet you're able to pay real time. So that's how you can go about paying through InstaPay for a much larger amount. Third is RTGS, or real-time gross settlement. This has been around for quite some time and is considered as one of the pioneering facility for domestic peso transfers. RTGS provides real-time peso settlement for an unlimited amount per transfer. Fourth, we have PDDTS, or the Philippine Domestic Dollar Transfer System. It provides US dollar funds transfer payment within the Philippines, almost real-time value credit. And it has been made available around the same time as RTGS, also considered as one of the pioneering domestic payment channels. Now, as for the treatment of charges for these payment channels, let me describe the differences. For the transaction fees for PesoNet and InstaPay, the fees for both channels are shouldered by just the remitter. So the final credit provided to the beneficiary is paid in full, right? So buong buo yung bayad. Now, in contrast to RTGS and PDDTS, the fees are covered by both the remitter and the beneficiary. So, on the perspective of the beneficiary, likely PesoNet or InstaPay would be the preference of your beneficiary if you come to consider paying through PesoNet or InstaPay. Now, moving to the right side of the slide, we have two intra-RCBC transfer solutions. This is basically the book-to-book transfer that I mentioned earlier. Fifth of our payment is doing it by bulk payment. When you say bulk payment, it means your account will be debited singly for credit to several of your different vendors' RCBC accounts. And this is done by creating a predefined supplier list for your scheduled payments. And then on the sixth payment, another way of paying is through ad hoc means. So in case you have, let's say, an unscheduled or urgent payment to make, your processor can just make a single data entry online and effect an ad hoc payment from your RCBC account to your vendor's RCBC account. So this is a single transaction in effect. Now, please do note that both bulk payment or ad hoc payment is on a real-time basis through ROC. So since it's book to book, it's real time. Now, if next slide, please. So yeah. On the second slide, this is a very interesting point that we would like to emphasize this afternoon. After presenting our payment channels, we are happy to share our releaser function. Now, the releaser function is uniquely BC's and is made available across all of our online channels mentioned earlier. No other bank today has this releaser function. Now, how does this work? Our releaser function is able to suppress the debit and credit entries from taking place even after online approval has been made. It will remain unposted and will only be released after your vendor submits their official receipt to your office. Now, submission could either be through email or physical submission. That's doable. Now, how is this made possible also? Right after online approval is done, an email is automatically sent to your vendor advising them that your company has a pending payment and that your vendor must present or submit their official receipt to claim payment. To collect the payment, your vendor will have to submit the OR to your company's designated releaser. Now, your designated releaser could be your cashier. Whoever is your cashier right now, you could assign that person as the releaser. So, upon presentation of the official receipt, your releaser will just simply log on to ROC and release the payment for credit to your vendor's account. After that, the releaser could also print or email a payment advice and give this to your vendor to certify that you have made the payment. Just to summarize the three benefits that is attached to the releaser function. Number one, it provides email notice to your vendors of payments to be claimed. In a way, you're able to reduce incoming calls from vendors asking repeatedly for payment availability. Second, since payments are suppressed, your company gets to enjoy the float of funds for as long as the vendor has not submitted their OR. Third, it provides you with an immediate solution for OR management. While compared to other banks without releaser function, funds are credited real time, minus the submission of the OR. So, your struggle to collect OR with another bank becomes a challenge right after payment. Okay. So in closing, please do approach your RMs if you wish to consider enrolling in our online payment channels so your company can experience its efficiency and safety. On the lighter side, just to tie in with what Mike said earlier about digital footprint, about food and essentials being bought online, still on the lighter side. Imagine this, doing online payments. Nowadays, that's what we're doing. When you order food or essentials online, you pay online. And then you basically credit the store's bank account or the restaurant's bank account so delivery can be made. It's that simple and fast. Same way if you use PesoNet, InstaPay, or even RTGS or PDTS, the other payment channels that I mentioned. So that's it for our payment channels. And thank you very much for your time, and thank you for having me.
Thank you very much, Nathan, for your presentation. And I'm sure that some of our clients are already excited to be able to utilize these products that you have just shown them. So here we are. We are now in Q&A portion. And I hope, Mike, you're ready for these questions. We did receive quite a few for our clients that sent questions. Again, our note, should your question not be answered during the briefing proper, don't worry, your RMs will get back to you within the day or within the week to be able to respond to the questions that you have sent. All right, question number 1. Here it goes, Mike. 2008 was the last crisis of similar magnitude. Can you compare 2008 versus the 2020 crisis in terms of the following? Number 1, the action of government. Number 2, the damage and extent of damage to the economies. And number 3, the length of time to recovery.
Okay, thank you, Stephen. First, the difference between 10 years ago or the 2008 global crisis. Back then, economies and the markets were, there's already some weakness coming from the subprime crisis. There were excesses in the past. Unlike now, we're coming from a position of strength. We have, especially our local economy has been among the strongest in 30 to 40 years. If you average, do a 5-year average of the growth at least 6%. Now, the measures being used are similar, though it's more it's already enhanced now when it comes to, we have seen the central banks locally and worldwide dramatically cutting interest rates. So we have that luxury now. Unlike there are earlier crises, especially in the 1990s, the Asian financial crisis, interest rates were very high. The peso was very weak. And that normally that's a killer for the economy. But now it's the other way around. It's stimulative, very stimulative, because we have very low interest rates, record low BSP policy rate at 2.75%. And that's going to help a lot, especially the sectors most in need, those who need the lifeline. It's going to support them more. It's going to encourage more growth. And the central banks have been infusing records and unprecedented amounts of money, liquidity into the financial system. And some of the money have been finding their way in the financial markets. That's why we have seen also sharp gains, a lot of money to be made in the financial markets recently. And hopefully the recovery this time, because now the only difference, the slowdown now is engineered and deliberate primarily because of the health issue. Economies have been strong to start with. Now it's really a choice to close the economies 2 months or so that to priority save millions of lives. And now, of course, we have seen deeper declines because these are unprecedented times when it comes to closing down economies in a deliberate way. But nonetheless, of course, that would require also maybe another 1 to 2 years of recovery. But the past crisis periods took them similarly. There were, other crisis periods even took 2 to 3 years. But now, hopefully 1 to 2 years, let the both the businesses, the consumers recover from their losses, lost sales, lost income, lost employment, and pick up the pieces and try to normalize the economy gradually. Hopefully, should there be this would be expedited and more. The rebound would be more sustainable should there be a cure. Thank you.
Thank you, Mike. I remember back in 2008 when I was heading the BDO asset portfolio. Definitely back then the experience was that the central banks were learning on the fly, and definitely this set of central bank right now, it's more like they come into this crisis with experience already, and you see it in the speed at which they put in place a lot of these stimulative and market calming actions. And if you look also at the movement of the markets, markets recovered during the 2020 crisis so much faster compared to that in 2008. So kudos to the central banks of this world for acting swiftly. Next question, Mike. Given the perceived damage to economies in relation to the lockdown and in relation to the Philippines, our first negative GDP since 1998, how long do you think it will take us to get back and recover the losses of this lockdown?
Well, as I said also earlier, it would take about 1 to 2 years. It's already signaled by a lot of industry players, those in the business sector. Realistically, especially on those who produce big ticket items, discretionary products, for instance, vehicles, even other industries like tourism that are hard hit, it would take realistically 1 to 2 years. Especially now, it's primarily a health issue. So social distancing would still continue. And we all know that for the next couple of months, it's good. That's still gonna be a drag to economic growth. Even if the economy opens gradually, or even if the ECQ is lifted to GCQ, so it won't be as fast initially. Give it some time, maybe towards the latter part of this year. But what's really more important is that the monetary authorities have learned quite well the lessons of the past. They have kept interest rates at very low and very attractive levels that would compel the businesses, conglomerates with deep pockets to grab the opportunity and make the move and borrow, lock in long term. And that would generate a lot of business activities as well. And then, of course, because this is really by design, it's really to help prevent, now it's contractions are given. What's really important is to prevent this economic contraction from spiraling further and to mitigate or minimize the risk of recession. So that's the penultimate objective. And on top of monetary easing measures, even the stimulus measures, especially we have seen the assistance to the most vulnerable sectors. So we will see more increased government spending, stimulus spending. So those are really designed also to prop up and at least to offset the economic losses due to the lockdowns.
Okay. Your response is bang on with the statements of Governor Ben Jokno that he expects and wants to keep rates low for long. So lower interest rates. Question. Given the current deficit situation with the Philippines, with all of the support that the government has done in terms of spending and in terms of bond buying programs, how do you anticipate the government will be able to marry keeping interest rates low and at the same time fund this rising deficit?
Well, now that's part of the delicate balancing acts that the government needs to manage right now, because they would increase the government's budget deficit to 5% of GDP. However, that is what everybody else around the world is doing that, so there's no problem. Even the US, they're now lining up huge borrowings and able to finance their stimulus measures. And same goes with other developed countries in Europe and the rest of the world, and also in Asia. We have seen records amount of new bond issuances, so there will be new supply. So, of course, there's at the same time, the central banks are infusing lots and lots of money. The likes of the U.S. Central Bank, the Federal Reserve, has made this pledge to infuse. It said that it won't run out of ammunition in infusing money, liquidity, and credit, and being able to ensure that borrowing costs would remain as low as possible, because that's what we need now. That's why they will fight tooth and nail just to make sure that they infuse so much money, because they can only do so much in cutting interest rates. It's already zero in the US. They cannot cut further. So what they can do is to infuse money, quantitative easing through unlimited bond purchases. And also locally, we have seen the central bank infusing liquidity also by way of cutting reserve requirements, and there is still another 200 basis more to go. So that's going to help infuse at least the excess liquidity would also find their way also in helping financing the stimulus spending. Because right now, even businesses are kind of conservative for gun operations, for gun sales. They're rich in cash. So, in short, a lot of businesses are cash rich, especially those with deeper pockets. So that's going to help for the meantime keep interest rates low and support the economy, and at least provide a good foundation for eventually a rebound in the coming months.
Okay, so you're saying that you are a firm believer that the BSP will keep rates low for long. But one of the reasons, or one of the main concerns of central banks during this crisis is the expected rise in non-performing loans, particularly in banks, particularly in the less deep pocket type of the sector of the market. What's your thoughts on this risk that the market is faced with, and how do you anticipate banks will be able to support lending in this kind of an environment?
Well, that has been a trend also being anticipated not only here in the Philippines, but practically around the world. We have seen banks increasing provisions worldwide, as well as locally. We have seen that on the latest disclosures. So that is expected, because if you have economic contraction, it would be inevitable for, especially even before the lockdowns, before COVID-19, there are already vulnerable sectors starting then. So all the more it's aggravated now by COVID-19. So at least they're just being prudent, but it's really too early to tell. What's really important is that well, the signals have been very well received, especially the local central bank. They have introduced so many tools and measures just to make sure that to incentivize as much as possible banks in lending more to the MSMEs. As a starting point, they allowed banks to include in their computation of reserve requirements new lending to MSMEs starting March 15. And the central bank governor has signaled that well, the current outstanding MSME loans in the country is around 540 billion pesos. And the central bank is estimating, initially about 3 weeks ago, the estimate was just 200 billion, but now they became more bullish. That could even be doubled with that kind of boom. And also the national government has already come up with a credit guarantee that's worth 120 billion. That's going to guarantee half to a central bank on local banks, such as reduced rate to 50%, as well as also loans and agricultural loans. The central bank was also temporarily allowed zero risk weight as well. So there are still many other measures that would all point out the penultimate objective of encouraging banks to lend more to the MSMEs. And that's also complemented by very low and attractive interest rates. You're able to make things easier. We all know it's inevitable. Some of the MSMEs, some businesses have been not operating for 2 months, and some of them may need cash. And because of course, they're not producing, they're not selling. Some of them are only partial operations. So those are the realities. But never in my personas have I seen all measures to support all of MSMEs, enable just objective to help them tide over, keep their jobs and layoffs, and for banks to take the opportunity to grow more, make new investments, expand, and create more jobs. And all that will help shore up economic activity, further prevent the effects of
Okay. Well, we're losing Mike a bit, but let's move on. I think in a nutshell, it seems that Mike is really, really, really convinced that the approach and the strategy of government is really to keep interest rates low. We know that there is going to be a deficit bump because of the support that the government is doing through asset purchases and through the fiscal stimulus. But we will just have to trust the government and see how they will ensure to keep interest rates low so that banks can continue to support the credit markets and the borrowing public in general. Mike, you're still there, right?
Yeah, I'm here, Steve.
Okay. One question. The Philippines is 60%, sorry, correct, I'll correct that. We are 70% dependent on consumer spending. We are pretty much like the US in terms of the GDP component with consumer spending. Remittance is expected to fall as companies abroad reduce manpower because of this crisis. What kind of impact are you seeing from consumer spending in relation to the drop in remittances?
Well, first, Stephen, OFW remittances, that's of at least $30 billion per year. We're number 4 in the world after India, China, and Mexico. Now, we've seen already some displaced OFWs, more than 20,000 already sent home. Good majority from the cruise ship or seafaring industries. And there are an estimated about 100,000 adversely affected or displaced. So we may see realistically initially a modest drop or single-digit drop in OFW remittances. And since they comprise 10% of the economy, and normally the rule of thumb there is that about close to half of the population are direct and indirect beneficiaries of OFWs, meaning for every family, there's at least one OFW. So that's going to adversely impact on consumer spending. But the thing is, given our culture, the unique peculiarities here in the Philippines is that even if some OFWs are displaced, given the lockdowns also in other parts of the world, especially in host countries, and also the decline in oil prices, that's going to impact also on big oil-producing countries that host large amounts of OFWs. So, despite that, they could still continue to send money through their savings. So that's an offsetting factor. But reality is, there would be a slowdown on consumer spending. And at the same time, we have to note that OFWs are the biggest market, one of the biggest markets, or the major market for, say, residential real estate, for consumer products like appliances, furnishings. So that would have an impact because they would be more conservative now in view of some uncertainties as to job security.
All right. No briefing is ever complete without questions related to the stock market. But of course, I know this is not an equity briefing. So let's just keep it simple. What industries should we avoid? What industries do you think will do very well in this kind of an environment?
Well, it's still, well, realistically, what would do well first are the essentials, those producing the basic necessities that well, especially now that both businesses and consumers as well as households are becoming more conservative in view of, well, of course, in view of recent losses on sales, some uncertainties on employment, on business for the meantime. So, so maybe avoid big ticket, well, those industries that produce big ticket transaction, maybe property, it would take a while, other durables, other highly leveraged industries. So what would do well? Because after the easing of the ECQ, imagine there is a pent up demand for a lot of consumer products and services. People have some people now have money, especially those with savings. They cannot spend as much as they can and as much as they should. So there is pent up demand on a lot of consumer products and services after the easing of the lockdown. So those consumer related industries are expected to benefit.
Okay. You've covered interest rates very well and very exhaustively. Of course, we can't let go of you without you giving us a strong view on the foreign exchange market. What do you think will happen to the dollar peso, and why do you think the dollar peso seems to be one of the better performing currencies in Asia?
Well, first, the Philippines primarily is a net importing country. We have seen a dramatic decline in global oil prices. Actually, it's almost a collapse in oil prices. Okay, fine. Now it picked up a bit to a little over $20 per barrel. It came from negative, and we have seen the more stable benchmarks like the Brent crude oil. The low was around $11. It's the lowest already. The last time we saw that was in the 1980s, in around 1986. So this has helped the Philippines a lot because the country imports almost all of its oil, and the country is saving about between $4 to $5 billion per year because of the cumulative decline of $40 to $50 per barrel. Since the start of the year, oil is still down by at least 60%. So because nobody's driving right now, you cannot really drive as much. You cannot really drive given the restrictions, the lockdowns around the world. So that's one. And secondly, we have the record high gross international reserves at 89 billion. That's almost 8 months worth of imports. The international standard is just less than half of that, just 3 months to 4 months. We have a very strong external position. And another important thing is that the Philippines has benefited from its investment grade rating at 2 notches above investment grade. The first time ever that the country got its investment grade was in 2013. And we have seen subsequent upgrades thereof. Now we have relatively higher bond yields compared to other Asian countries. Other Asian countries are close to zero. Japan is even negative. We're still at 3% levels. But it's kind of stretched already at that point because it's very rare that we see interest rates at this level. So that's one of the reasons. Given the hefty gains in the bond market, that's one clear manifestation that lots of money, lots and lots of money have been made here in the Philippine market. And that has kept the peso relatively stronger. And as a matter of policy, a stronger peso is good for maintaining a benign inflation. Unlike in other Asian countries, like the likes of Thailand, Taiwan, South Korea, and even Japan, they would fight tooth and nail to weaken their currency. Even China, they would try as much as possible to weaken their currency because that's going to stimulate economic growth by way of making their exports more price competitive, as well as making their tourism also price competitive. Unlike here in the Philippines, it's the other way around. We need to manage inflation, our imports. That's why a stronger peso has been very much favorable. And that is still expected to continue, especially now that our credit ratings are relatively favorable.
Hey, thank you very much for that, Mike. So, in a nutshell, dollar peso, we are positive on the peso. So exporters, that's a risk for you. Importers, maybe not so much. Interest rates, you're expecting interest rates to stay low, government to keep it low, and that is good for borrowers. Borrowers look to lock in. I think that's what Mike was trying to say. The economy, we will be in a hiccup. We'll probably get into a technical recession with negative first quarter and negative second quarter GDP. But we expect a second half of the year bounce as we get out of the ECQ and as the rest of the world gets out of ECQ. So I guess right here, we just have to trust our government. The government promised a lot to us to keep interest rates low and keep on priming and keep on supporting the economy. We will just have to see. So May 15, hopefully we get a bounce in the markets, and hopefully you, our clients, enjoyed this briefing. You listened a lot to Mike and absorbed what Mike has provided us today. This is Steven Reyes, Treasury Sales Head. Thank you for attending the RCBC briefing.